Welcome to today's video. Have you ever wondered why the stock market suddenly surges or crashes after major announcements? What is it about news like interest rate changes or inflation reports that makes traders react so sharply? Economic news isn't just headlines, it's a driving force behind market movements, shaping trends and creating both opportunities and risks. In this video, we're diving deep into the fascinating connection between economic news and financial markets. Whether it's a central bank's decision or a key jobs report, these events can spark extreme volatility. Stick around as we break down why this happens, how you can anticipate market reactions, and most importantly, how to leverage these moments to your advantage. By the end, you'll have the tools to turn news into actionable insights for your portfolio. Let's start by identifying the most impactful types of economic news and understanding their ripple effects on financial markets. Central banks, like the Federal Reserve or ECB, play a massive role in setting market expectations. Their tools, primarily interest rate changes, affect everything from corporate profits to consumer spending. A rate hike often signals tighter monetary policy, which can slow down economic growth. Markets tend to sell off in such scenarios, especially growth-oriented sectors like tech. A rate cut, on the other hand, boosts borrowing and spending, often leading to a rally in equities and other riskier assets. When the Federal Reserve announced aggressive rate hikes in 2022 to combat inflation, tech-heavy indices like the Nasdaq plunged over 30%, while safer assets like bonds gained appeal. Inflation is a double-edged sword for markets. High inflation reduces the purchasing power of money, increasing costs for companies and consumers. If inflation rises beyond expectations, central banks might act swiftly, leading to heightened volatility. In 2021, US inflation hit a 40-year high. As a result, energy and commodity stocks thrived, while tech stocks struggled due to rising interest rate fears. Reports like non-farm payrolls in the US are closely watched because they indicate economic health. If job growth is strong, markets may interpret it as a sign of economic resilience, encouraging risk-taking. If job numbers fall short, investors might expect slower growth or even a recession. A surprisingly strong jobs report in 2023 led to increased bond yields, as traders braced for potential rate hikes. Economic news isn't just about macro data. Micro-level events like corporate earnings or trade balances can shift entire sectors. Widening trade deficits can pressure domestic currency values and impact export-heavy industries. Negative surprises from major companies often lead to sector-wide sell-offs, even if the overall market holds steady. Now let's dive into why markets behave the way they do after news breaks. Markets don't just react to news, they react to whether the news aligns with expectations. If traders expect a 0.25% rate hike and the central bank delivers that exact number, the market response may be muted. However, a surprise 0.5% hike could lead to panic selling. Stay informed about market expectations using tools like Bloomberg or Reuters consensus forecasts. Fear and greed dominate market behavior. These emotions often amplify market reactions to news. Negative news like recession risks leads to widespread panic selling. Positive surprises can drive rapid buying, sometimes creating unsustainable bubbles. News often triggers knee-jerk reactions. For example, a negative earnings report might cause a stock to drop sharply in minutes. Markets adjust as more data emerges. A company that initially misses earnings might rebound as analysts reassess its long-term potential. Finally, let's cover practical strategies to leverage economic news effectively. Keep track of high-impact events like Fed meetings, GDP releases, and inflation reports using an economic calendar. If a central bank meeting is approaching, avoid opening large, risky positions the day before to limit exposure to unexpected news. Relying too heavily on one sector or asset type exposes you to concentrated risk. If inflation rises, sectors like energy and commodities may outperform, while tech might struggle. A diversified portfolio balances these risks. Volatility isn't just a risk, it's an opportunity. Use tools like options trading to hedge against major swings. For instance, buying put options during earnings season protects against sharp declines. If you're confident in your analysis, wait for overreactions to enter positions at favorable prices. Pay attention to sentiment indices like the VIX, which measure market expectations for volatility. If the VIX spikes, it may indicate panic selling, presenting buying opportunities for long-term investors. Economic news can be stressful, especially when markets are volatile. Stay calm and stick to your plan. Avoid emotional trading based on headlines alone. Markets move fast, but staying informed and prepared is your best weapon. Whether it's a surprising jobs report or a central bank decision, knowing how to interpret these events can turn volatility into your advantage. Keep learning, stay focused, and make every trade a smarter one. If you found this video helpful, don't forget to give it a thumbs up. Your support helps us create more valuable content just like this. Hit the subscribe button and turn on the notification bell to stay updated on our latest videos about investing strategies and market insights. And we'd love to hear from you. Drop a comment below with your thoughts or questions. Thanks for watching, and see you in the next one. If you found this video helpful, don't forget to give it a thumbs up. Your support helps us create more valuable content just like this. Hit the subscribe button and turn on the notification bell to stay updated on our latest videos about investing strategies and market insights.